Good evening, dear clients. This evening, Hafsa Segwia is my name. I will be taking you through the policy amendments for this year, that is 2024-2025. And I am working with a lady called Lydia Nakabidi. She's in my team. We are going to take you through the different policy amendments in the different tax types in their categories. So normally when it comes to June every year, everybody is eagerly waiting for to hear what is in the budget for them. And every year, the Minister of Finance, who happens to be a supervisor, reads the budget that comes through with policy amendments in the different tax types, because we have income tax, we have VAT, we have stamp duty, we have excise duty. So ideally, all those tax types under them, that is where we expect to find the different amendments that follow through, where we need to be a little keen as we are reading them. So I think I'll start with income tax. And in income tax, the amendments are not very many. We have exemptions, and some of the exemptions are on income that one can derive after disposing of government securities on a secondary market. If you've ever been keen at the activities on stock markets, we have primary markets and we have secondary markets. So in secondary markets, people don't usually trade on them. They usually trade in the primary markets. So here, this is basically intended to promote the development of this secondary market by encouraging people to buy and sell the financial securities there. So that is why the income that you will derive while you're operating on a secondary market, while disposing of government securities, it is exempted from tax. And normally these, normally what we pick from them, if we're talking about tax, it's normally withholding tax. So here we also look at income that is derived from private equity or a joint venture capital fund that is meant to be regulated under the Capital Markets Authorities Act. And the intention of this is to encourage growth of alternative financing sources to finance private investment. So that is why the income that you derive from or by a private equity or venture capital fund, that income is exempted so that you can continue dealing in the same. So when we move on with exemptions, this year we have income that one can derive from manufacturing electric cars. You could be aware that we have cars that are meant to use electricity because they are basically charged. The way you charge a phone, they are basically charged. And we have those that are hybrid. They could double as using electricity and equally using the fuel, maybe petrol or diesel. So this year's exemption in this area looks at a manufacture of an electric vehicle or electric batteries or electric vehicle charging equipment, or even going further and looking at one who fabricates a frame or body of an electric car. So this particular kind of person will have their income as in exempted from income tax moving forward, and equally VAT, income tax and VAT. So we also look at one who derives income by a person who operates a specialized hospital facility, where this investment capital is 10 million US dollars if you're a citizen, if you're a foreigner, sorry, and 300,000 US dollars if you are a citizen. If it is meant to be placed up country, it's just 150 US dollars. So ideally, the more it depends on where you place depends upon where you place your hospital facility. If you place it outside Kampala, then ideally the capital will be lowered for you to be regarded as an investor in that area. So we continue looking at the concept of permanent establishment. Ideally, before we have been looking at what we call a branch, because a company has been having maybe the headquarters and a branch. So in these amendments, we are basically replacing a branch for permanent establishment. So the law is clear. It introduced what we call a permanent establishment. And the reason why it did so is basically to align ourselves with international treaties on double taxation, because some of you could be aware that we have, Uganda has a number of double taxation agreements it has signed with some countries whereby we don't need to tax you this side and probably that side, depending on where you have the investments. We need to tax you at one point. So that is meant to strengthen on that. Then ideal also, it went ahead in the tax law, that is income tax, created a separate section, that is 78B, that basically shows you how to calculate chargeable income of a permanent establishment. So these are some of the amendments that probably we have. Then also income that is derived from an insurance premium, if this premium relates to insurance or reassurance of a risk in Uganda. It should be specific. It should relate to insurance or reassurance of a risk in Uganda. So that is where some of these are basically explained. So we will be moving on, and still under income tax, there is an introduction of a 10% withholding tax on commission paid by a payment service provider. Here, the way you would see a banking agent and any other agents offering financial services. Ideally, banking agents have been in the loop, but we're trying to look at those who there's cheaper cash, there's forgotten the other ones. Those we want to level the ground so that they are all paying the 10% withholding and not only leaving the banking agents in that kind of arena. Then we can continue to VAT. VAT is a different tax type altogether. It's a consumption tax and it is borne by the final consumer. When I say borne by the final consumer, I am looking at that last person on the chain of supply and movement of this item. For example, if I could give you a soda manufacturer, when the manufacturer manufactures soda, they will put on 18%, and the distributor is meant to pay the 18% to the manufacturer. Then the distributor will equally go ahead and supply to area agents and will invoice them inclusive of 18%, and they'll pay it. Then the area agents will go ahead and supply. They'll supply to supermarkets, they'll supply to maybe wholesale shops. So they'll supply to hotels. So you who is going to go in that supermarket in the evening and you pick that bottle of juice or soda in the fridge and you're going to drink it, you are going to pay inclusive of 18%, and the tax burden rests on you. So that is the illustration I wanted you to understand me when I talk about VAT. So here among the amendments we have in VAT is a supply of goods through auction shall be treated as a supply of goods by a recipient of the proceeds of the auction. What does this mean? Last financial year, 2023-2024, if I'm not mistaken, an amendment came in that relates to this and was basically pushing all auctioneers to register for VAT, because just by the work they do of auctioning, that good was classified as a supply of that good. So we had to register those, all of them, for VAT, though they were qualifying by turnover or not. But going through that in the course of the year, we discovered that it's a little unfair, because this person may be an auctioneer, but can't make 150 million. So now what we are basically looking at, who is going to account for VAT in this kind of transaction? The person taking the proceeds of the auction, who is that? For example, Bank X wants to sell particular property of vehicles. because it doesn't deal in that. But because it held this property as collateral, and certain persons fail to pay or to fulfill the obligations, they want to auction and probably get out the monies that were outstanding on behalf of particular clients. So it will need services of an auctioneer. So at the end of the day, for the auctioneer performing his duty, whatever comes out of the auction are the proceeds. And these proceeds go to the bank, these proceeds go to whoever has told them to auction. So this is the person who is meant to account for VAT in this particular scenario. So I wanted to bring it very clear so that you understand it. And next, the other amendment is for VAT. A person liable to pay VAT in cases of supply of goods through auction is a recipient of that one. We have talked about it. Then employers who are VAT registered shall be required to account for VAT on any taxable supplies. Let me first go where I was. On any taxable supplies that are gifted or donated to their employees. What do I mean? If you're an employer and you are VAT registered, just by the goods or services you deal in, you've been picking VAT. That's well. So you, the employer, the same employer, goes and buys certain a consortment of items for your staff. Normally you give them Christmas hampers, end of year hampers, Eid hampers or gifts. So in the event that the things you bought, you have paid VAT within them, and you're equally going to give them out to staff because this is not business, you need to account just for that VAT in your return, but it will equally be a balancing transaction because you're going to account for VAT and tell us that this is the input VAT. I bought these goods at this amount of money. I paid VAT of this much. Then at the end of the day, as the goods are going out, it's not a sale, but you just recognize it in that way. They'll be going out with the same amount of money because you are not in business. That is what we were trying to put right. And the reason why this is there is we do not want you to mix the items that you're gifting to your employees with those that you deal in. So that is the other amendment that was creating clarity. An increase in input credit offset threshold from 5 million to 10 million. What is this one trying to emphasize? In VAT, we have 3 types of returns that we expect you to be filing at least any of those in a particular month. We have a payment return, we have a nil return, we have a credit return that starts from offset and will graduate into a cash refund in case the offset was exceeding 5 million. That is where we were. So this amendment is clearly telling you, you can no longer apply for cash for a cash refund in case your offset, the amount of the offset is not making 10 million. We've upped it to 10 million. Initially, it has been 5 million. That means you come with the offset and carry it forward. When it makes 5, you are free to apply for a cash refund. And in applying for a cash refund, it is where you are taking cash refund instead of offset. So when the application was reaching us, our work is to verify and see what brought the refund, or what brought the offset, where did it come from, as far as which month up to date, and maybe ascertaining whether actually the invoices you are fronting actually happened. So that is one of the amendments in VAT. Now we are moving a cash refund to be from 5 million to 10 million. Your offset should at least make 10 million for it to graduate into a cash refund. So still for VAT, 4 stage has been 0 rated. And now we are putting it into the standard rated arena, because we say supply of 4 stage stamps, the supply of software and equipment installation services to manufacturer, and the supply of services incidental to telemedical services and loyalty paid in respect of agricultural technologies. They have been exempted, but now they'll be subject to VAT at 18%. The supply of goods and services to contractors and subcontractors of power projects, for example, hydro, solar, geothermal, wind, and biogas, for personal and domestic use is subject to 18%. Reason why this came, because when you look at projects, those are normally big projects for contractors and subcontractors of power projects. So normally they've been purchasing, and declaring all the input to be business related. So here we want a segregation of what is business related and what is personal. So whatever comes under the personal and domestic use will still be subjected to 18%. Then we only look at expenses that are business related and not those that are personal. So in the event that you deal in any of these, kindly try to be very keen when you are submitting your return to place an item where it has to go. So we basically also look at some exemptions in VAT. These are initially now in the third schedule, because in the compendium this year, our exemption schedule is in the third, not the second as it used to be last year. So we are also looking at the supply of locally manufactured electric vehicle or supply of locally fabricated frame of body of an electric vehicle. Then the supply of vehicle charging equipment or supply of charging services. All these will be exempted from VAT. The supply of safety headgear, basically to those who are doing some construction and some huge works on specific projects that need the safety headgears, so that they can be equally affordable for them to acquire them for their workers. Then supply of cooking stoves that use fuel ethanol assembled in Uganda up to 30th June 2028. This is basically to make these stoves affordable when they don't have any VAT, because normally if the stoves are affordable and they use ethanol, we'll be reducing the deforestation, where we need to cut the trees, we need to make the charcoal and all that, because when you use these stoves, we basically use fuel ethanol, which comes from cassava. So equally, the supply of services to conduct a feasibility study, and here we have a supply of locally produced material for the construction of a factory or warehouse, and the supply of locally produced raw materials or inputs. Definitely these, you are supplying an investor or somebody who is in the free zone, who is trying to put up something still for the electric vehicles, electric batteries, electric vehicle charging equipment, or fabricators of the frames and bodies of the electric vehicle. So basically those are equally exempted from VAT. We looked at them in income tax and they had an exemption. Even VAT, they have an exemption. So it's basically a blanket exemption. Then we can move on to excise duty. And excise duty has a few amendments. We are looking at opaque beer, what we call Chibuku beer. It's from 12%. It has been 12% or 230 shillings. So now it has remained on 12% as an ad valorem rate, or 150 shillings per liter. You remember in the first statement I wrote it was 230 shillings per liter. Now it has moved down to 150 shillings per liter. we have lowered the excise duty on that kind of beer. And any other alcoholic beverage locally produced, ideally, it has also moved from, it was 20% or 230 per liter. It has moved to 12% or 150 per liter. These are basically going down. And what is new in the excise duty law for amendments this year is the introduction of powder for reconstruction into beer. We haven't been having powdered beer. What we have here is maybe you'll be buying them in kgs, in sachets that are kg based. And when you buy your kgs, you go and read instructions. You can reconstitute the beer, add water, add whatever they tell you, wait for whatever period, then you'll be getting some beer. So here for excise duty purposes, each kg will be at 2,500 for terms of excise duty to those who will be dealing in it, manufacturing it. When we basically look at undenatured spirits of alcoholic strength by volume of 80% or made from locally produced raw materials, this is at 60% or 1,500 per liter, whichever is higher. Then still undenatured spirits of alcoholic strength, volume 80%. This is at 100% or 2,500 per liter. The reason why we give you those, we give you a fixed rate and we give you an ad valorem rate. So whichever is higher is what basically we are going to be picking moving forward. So let me look at another. Any other alcoholic beverage locally produced other than the beverage we've referred to up there, then it was initially at 12% or 150 per liter, but we have lowered it to 100 shillings per liter because it's locally produced. What you realize under excise duty, under the Excise Duty Act, those items that are locally produced, we normally pick less of excise duty from them. So we continue to mineral water, bottled water, and other water purposely for drinking. Ideally, we have been picking excise duty of 10% per liter. What we've introduced here, we've introduced a fixed rate, 10% or 50 shillings per liter, whichever is higher. Then we continue to adhesives, grout, or lime. Here we are looking at those in the hardware sector. Initially, we have been picking excise duty on only cement at 500 shillings per bag of 50 kilograms. But now we have included other items. We've included adhesive, what we use when we are fixing tiles. We've included the grout. We equally use it when we are fixing tiles. We've included the white cement or lime. So they are all into that bracket. It's 500 shillings per 50 kg bag. So now it's all inclusive. So if you're in a hardware, you should know that if you're producing them, you should know that as you're ascertaining your ex-factory price, you have to factor in the excise duty on adhesives, on grout, on white cement, on lime, as you've been doing it for cement, so that you cannot make a loss on that, because the person who comes to buy is the person who is going to pay you. So here we move on to petrol, motor spirit, gasoline. We have been picking 1,450 per liter. It increased by 100 shillings. And now we are picking 1,550 per liter of gasoline, and gasoline is petrol. Then gas oil, that is locomotive light amber for high speed, that is diesel. We have been picking 1,130 per liter. That is excise duty. So within the price we were paying per liter, we were picking the 1,100. We were picking 1,230, 130. Now we are picking 1,230 effective this year. So here we are looking at still excise duty exemption on incoming calls from the United Republic of Tanzania. Initially, the East African countries, the arrangement we have, that's the East African community countries, we haven't been picking excise duty on those calls, the international calls that come in. But recently, Tanzania joined the East African community. So we felt it wise to give them an exemption on the incoming calls from the United Republic of Tanzania to Uganda. So we also introduced a 0.5 excise duty on cash withdrawal services provided through a payment system. These services provided by financial institutions or microfinance deposit-taking or agent banking are excluded because initially they have been in the loop and we have been collecting from them excise duty on the deposits that people make. So here we have also exemptions on furniture, furnishings and fittings or locally produced materials for construction of premises other than infrastructure for specialized hospital developers. The reason why we are not including specialized hospital developers here because one, a specialized hospital has a blanket exemption on income tax, has a blanket exemption on VAT. So it is already covered under there. That is why here we are intentional and we ensure that it is not included. Then here also look at excise duty. We have an exemption on construction materials to a manufacturer of an electric vehicle or electric battery or electric vehicle charging equipment or fabricator of a frame or body of an electric car. So in the event that you're constructing any of these plants, excise duty is exempted from you. Then we move on to the tax procedures code. And here we are very intentional. A taxpayer who fails to inform the commissioner, a taxpayer who intends to claim a deduction of or credit for goods destroyed as a result of damage of trading stock, expiry of trading stock, damage of damage of manufactured stock, expiry of manufactured stock or absolute stock is required to inform the commissioner, that's a commissioner general in writing, in a prescribed form before destroying the goods. Reason why we need to create an emphasis on this, you realize that for those who are VAT registered, when you're operating on the IFRIS platform, it is very easy for you to go if you have stock that is damaged, that is destroyed, that caught fire, that became obsolete. Ideally, you just go and reduce the numbers, then they reduce it by that. But the reason why this came, we felt there is a risk in doing that. You could reduce the stock via that in VAT, but what about income tax? We need to know, in case you're to claim a deduction of a credit, then we need to know what exactly happens. That is why you are put to task to write to the commissioner. And if you fail to inform the commissioner, then this claim of the deduction of the destroyed goods will not be granted to you because we need to understand what exactly happens to that. Still in the same tax procedures code, we have an extension of the waiver. To take you back, last financial year, or let me start from COVID. The first waiver started in 2021 that by 30th June 2021, we looked at you and wanted to ascertain whether you have an outstanding liability. What we're instructed to do then in 2021 is to waive the penalty and interest you had then. Then you just struggle with the principal tax and see how best you can pay it. So in 2023, 2024, that was last year, we made an amendment onto the waiver. And now the waiver we were handling last year was one that had a conditionality. We told you to look at yourself from inception or from when you got the tin up to 30th June 2023. Then look at yourself, ascertain your tax position. How are you standing, or how do you appear in the eyes of the authority? Do you have any outstanding? And ideally, if you have an outstanding, it should have a principal. That's the actual tax. It has a penalty. Maybe you filed a return late and we slapped you with penalty. It has interest. Interest accrues when there is unpaid tax to government because it's a debt. So we told you simply work on the principal tax, see how to clear it or clear part of it. We are going to waive the interest and penalty. If you clear half or a bit of it, we'll also waive the interest and penalty on a pro rata basis, implying that in proportion of the principal that you have paid. So what we did this year, because it had a timeline for payment, last financial year, you were meant to pay by the 31st of December 2023. So what has happened this year, there is an extension of the payment period. So here it basically speaks any interest and penalty outstanding as at 30th June 2023. That means it's outstanding 30th June 2023 and prior shall be waived where the taxpayer pays the principal tax by 31st December. So that is basically the waiver we are moving with. And kindly look at yourself and see whether you have any outstanding with us, so that you can take advantage of that window, because it will save you of the penalty and the interest, so that you pay something reasonable and little, so that you can save on that. And we have some stamp duty that clearly talk about excluding shares in a limited liability company that was incorporated in Uganda, acquired by investors in a private equity venture capital. As we clearly talked about in income tax, they will also be exempted here from paying the shares, for picking stamp duty at the end of it at their disposal. Then we also looked at nil duty rate for capital duty or nominal share capital, or any increase in share acquired by an investor. This basically leans more to those in the investment. Then we basically looked at an increase of quantity of raw materials to be used by strategic investors to 80%. Formerly it was 50%. That is basically an increase, and it is addressing some clients in that area. So for stamp duty, we don't have a lot in there. I wanted to see what exactly is left. I think that would be all. Maybe for adjustments these are just administrative measures. They are not policy amendments. So the VAT return has also been adjusted to include provision to facilitate filing for VAT of auctioned goods. by a VAT registered or non-registered taxpayers. We talked about it. This is just administrative because I just wanted to let you know. Then maybe the other administrative we have here is we are trying to update the ledgers to waive the qualifying penalties and interest and subsection 40 of the TPC, and maybe online notification of the commissioner in case you have stock that has been damaged that is not sellable. We want to put an online notification where you don't need to write to us, but you just go online and place in that particular letter, then we can see it. Then here under the digital tracking solution, it's a track and trace solution that is going to help track specific excisable products and involve stamping of designated products with a digital stamp for tax purposes. I think this has been there. We are just re-echoing it moving forward. I think that is all with the amendments we had for this financial year 2024-2025. Over to you, Cyrus. I think I am done on my side.
Thank you so much, Madam Hafsa, for the precise but as well as a detailed facilitation and kind of presentation for this evening. We are going to kick in directly with the amazing questions from the entrepreneurs, and then you can respond to them. The first question, which was coming from Basa Davis, goes like, are there tax incentives for tech startups? Those are technology-based startups, especially SA or SaaS startups. That is the first question. Maybe you could respond to that, but while you're responding to that, I'll also pose another question. Is maybe after explaining to Ivan, would you also take us through the process of how the locally based startup can access the tax exemption which is usually given? How long is it? Is it 5? Is it 10 years? How is it calculated? And what would be the process for that? Maybe with the answers from those questions, then I'll pose the second set of questions, Madam Hafsa.
Thank you so much, Cyrus. One is asking that are there any tax incentives in technology services? As I clearly mentioned here, I didn't exactly feel any direct incentives that are tailored to that industry unless you're going to do business process outsourcing. Maybe that is where it comes in when you outsource the business process from another entity, and normally they outsource from other countries. Maybe that is when the story can try to come in, but not really here because I haven't felt it in this year's amendment. And maybe another ask about locally based investors. How do you get the 5 years? Let me be clear. For an investor, you have to fulfill certain conditions. One, we are looking at the core capital you are injecting in a project. And if you're a citizen of the East African countries, that implies that you originate from Uganda, Kenya, Tanzania, South Sudan, Ethiopia, Rwanda, Burundi, any of those. We expect you to have a capital base of at least 300,000 US dollars. If the establishment will be placed up country, then we expect you to have 150,000 US dollars. If you're a foreigner who doesn't originate from the East African community, then we expect you to have 10 million US dollars. So I think you see, for somebody who's not coming from East African community, then the core capital goes up. That is what you will realize. And secondly, you should be investing in specific sectors. We are looking at manufacturing, we are looking at footwear, we are looking at mattresses, we are looking at agro-processing, adding value to agricultural products. So it is intentional where government dictates where it needs or it requires you to put money. And thirdly, you should be able to, your wage bill, at least 75% of your wage bill should be covering locals. You should be able to employ the local people rather than bringing people from other countries. Then your raw materials should be locally sourced within Uganda upon availability. So there are conditions you have to fulfill so that you become an investor, for you to benefit from the 5 or 10 years tax exemption. Short of that, then at times it may be a little tricky on your side. So that is all I have for those who were trying to look at the incentives for the startups or the small businesses. And maybe another incentive I would feel is a little direct. As we are taxing, say, income tax, when we do register, you say today when you're a small business and you can keep your business records well, you can give me that return. Hello?
Yes,
You
we
can
do hear
give
you,
me
madam.
that return in the right time. And what do I call the right time? When my year starts on 1st July, in the first 3 months by the 30th of September, I expect you to be giving me your return. If it's a provisional return, I expect you to be getting it at that time for an individual. And if there's a payment, that's when I expect you to be making it good. If it's a non-individual or a company, I expect you to be giving me that return by the 31st of December of that year. So if you are able to do that, and if your turnover, at the same time, if your turnover does not exceed 10 million, then at the end of the day, I will not pick any income tax from you. But you will have complied with what I need, then we wait for the following year. So that is also another incentive that people may be overlooking, but it is a direct one that costs you nothing as a startup. Thank you.
Thank you so much, Madam Hafsa, for the prompt answers. From the attendees, if you have any question, you can type in the chat as we are reaching the concluding part of it, or you can raise your arm so that we can unmute you, and then you utilize this chance effectively when the expert is still here with us. Maybe a question out of, as we are waiting for the questions to come in, a question which is out of the exemptions. I received this question from the WhatsApp, and entrepreneur requested to ask, to put this question forward to you, Madam Hafsa, that he had started a business back in around 2015, 2016, and the business did not come to implementation, yet it was attached to his TIN number. And then he told me that he wrote to the URA. And after writing to the URA, he thought that the URA had acknowledged the email. And he started a new company, I think for the past 5 years, around 2019, 2018, around there. And then he said that unfortunately, he receives more messages, either requesting him to pay income tax around there. And he was like, how can he go about that to ensure that is no longer the other business which didn't come to life is no longer causing the sending of messages from the URA parastatal.
Thank you very much. For one who started business in 2016 and got an tin then, but along the way things did not materialize, then probably wrote to URA. That was the best step to take. But maybe what he did was he didn't complete it. As you write to URA, there is a difference in between acknowledging your letter and giving you a response that we are going to do this, or this is what we have decided to do. Because the essence of writing to URA is to let it know that business did not take on or has failed. And secondly, to request them probably to deactivate the tin and first put it on hold until you sort yourself. You will come back and apply for reactivation of the same tin, and we can give it to you back. The reason why one needs to do this, so that for the time you are not trading, there won't be any assessment that will be passing over that tin on an assumption that you are busy trading. So maybe somewhere he lost it and he failed to inform us. So that is why the assessments still come up and the notifications and reminders still come up. Maybe what I would advise him is to go to the nearest URA office with his PIN and his national ID. Then he will request one. They will help him see how to apply for an objection, to object to those figures that he doesn't agree with. Once that objection is well managed and done, and you get an objection decision, then the other thing, in case you haven't, if you still don't have business, you will need to ask to apply for a reactivation, a deactivation, where we give you a form that you fill and tell us what to deactivate. Is it just a tax type or is it the whole thing? And the reasons why, so that we can do it. When you are back with your feet again, you can come back and do the reactivation and moving forward. So that is the question that I got. Maybe in the chat, there's something I had seen. If I get a contract to supply agricultural inputs, do I have to be charged VAT? Ideally, when you get a contract to supply and you are not VAT registered, kindly you have to be a little keen to know what agricultural inputs you are meant to supply. If they're just these agricultural supplies that you're supplying, most of the agricultural supplies are not vatable because there is no value addition in them. So you just need to first get clarity to see what you're supplying, how it's defined in the VAT Act. Is it exempted, an exempted supply? Is it zero rated or is it standard rated? So that you can know. And secondly, don't apply for VAT because you feel you need to do a supply. VAT has its own requirements because it requires you to have a turnover of at least 37.5 in a given quarter. That is gross turnover, not profits. And secondly, VAT has a big job of you filing on a monthly basis. Kindly, before you can commit yourself to a tax type, first understand it, and secondly, know whom it's meant for so that you can make an informed decision. I think that is the only question I found in the chat. I think that is it.
Yeah, it looks like it's the only question which was remaining from the chat room. Dear attendees, if you have any other question, kindly raise your arm in the next 1 minute before we bring this to an end. Besides that, I would love to appreciate you, Madam Hafsa, for sparing time and coming to share such amazing and valuable information with the entrepreneurs, and also trying to make it not only precise but a bit relatable. Yeah, since entrepreneurs, we follow into different categories: the elites, the semi-illiterates, the elite literates. So thank you for making it relatable so that at least everyone can really comprehend and connect with the information. At this point, I would love to appreciate Einstein Rising for always ensuring that these master classes keep going since 2021, and entrepreneurs get access to such valuable and imperative information to see their social businesses keep moving. Madam Officer, maybe as you are coming to give us the parting shots, there was also a question I received via WhatsApp here. Let me try to check. Let me try to check it. And read it directly here. Let me check here. So it reads, what are the advantages and disadvantages of using EFRIS for a company with annual returns of 10 million and below that has no permanent employees, trying to distribute in local and international stores, and which tax incentives are available for such a business? Maybe let me repeat for one more time. What are the advantages and disadvantages of using a free system for a company with annual returns of not more than 10 million and below, like of below 10 million in simple terms, that has no permanent employees but trying to distribute for both local and also international stores? And he was also asking about which tax incentives are available for such a business. Maybe as you are answering that one, after you can give us the parting shots for today's incentive and tax exemption masterclass.
Thank you very much. This client is a small business, I would imagine, because of the turnover he has indicated. He does not make 10 million. It's less than 10 million, his annual turnover. It is well because when we were rolling out IFRIS, those letters are intentional. E for electronic, because you were meant to use an electronic gadget. If is for fiscal, because this transaction has a monetary value and has a tax component. Then R is receipting. We designed the receipting for entities that were not or could not be VAT registered, maybe because of their turnover, they haven't qualified, but we gave them a window that in the event that they want to use IFRIS, they can register freely, but what they will be doing is to only issue an e-receipt, not an e-invoice. Then I is invoicing, basically only those that are VAT registered. Then S is a solution that came to address certain challenges. So with IFRIS, you will either invoice or receipt, but you can't do both. So for such a person, in case he wants to use IFRIS, it's well, you just need to register. After registration, you configure your items or services you will render. If they are goods, then you need to stock them in, then wait for when you will invoice. What are the advantages? When you're operating on the IFRIS platform, you're prone to have or to get more people to work with you in business or to get clients, most of the bigger clients, because ideally the bigger clients could be VAT registered. They will appeal more to you than somebody who is not IFRIS registered. Then what you'd say a disadvantage, not really a disadvantage, but it will push you to be doing your work online. because you need to use an electric gadget to be invoicing. I wouldn't say there are many disadvantages. There are more of advantages. The only thing is maybe that data element, that small data element, but at least with the advantages, it even helps you with the bookkeeping. You don't need to acquire a different software to keep your records. Once you're using IFRIS, it's good enough. You can keep your records just there because they are equally saved online in case the actual invoices get issues. They are saved online, the information, so you can easily get it at any one time. That would be my response, and maybe to the team that has been listening in, that logged in, the 22 people who logged in. Thank you so much. We do appreciate you as you are a. We do appreciate your time, learning together, wanting to be that great client, that compliant client, that client who pays their taxes, who contributes to their fair share of taxes. Thank you so much. We don't take you for granted because paying taxes is not a thing everybody would want. But if you come up by yourselves and joining in the webinar, we will keep learning together. We are meant to simplify your life. We need to walk this journey with you so that you do not get difficulties in doing your business while you are complying. If all of us pay a little, there won't be anybody paying much. We can all contribute a little until we put it together and achieve the target that we are meant to do collect. But have a wonderful evening. Until we meet again, do not forget to pay your taxes as we develop Uganda together.
Thank you so much, Madam Hafsa. How I wish it was a physical masterclass. I would have invited the attendees to give you a thunderous hand clap. But I know they are clapping for you in the background. It has been a pleasure having you. Looking forward to engage you more in different other various segments of taxes and always thank you for being welcome as the government parastatal. Whenever we do invite you to pass valuable information, the amazing entrepreneurs. For clarity, we had to almost 32 entrepreneurs who clicked in, but others dropped in at certain points. Thank you for the 23 entrepreneurs who have completed to the last bit of it of today's masterclass, which has been about the incentives and exemptions. You are a dupos to the Ugandan-based business owners. It's a pleasure always hosting this masterclass. Thank you, Einstein Rising, for not only funding, but also ensure that these masterclasses has kept moving for now continuously 4 years. Thank you so much, the entire team.